Well, good morning. I'm Jaginder Rana. So, taking the topic today, surrendering the life insurance policy before maturity. Surrendering life insurance policy before maturity. When you opt out of a policy before its maturity, it is called surrendering the policy. The amount that you receive at the time is the LIC policy surrender value. That is life insurance policy surrender value. So the life cover stops immediately and you won't be able to revive it in the future. So surrender policy is not recommended since the surrender value of life insurance policy will always be substantially lower than the original benefits promised. Then when can you surrender life insurance policy? For single premium plans, you can surrender in the second year. And for limited and regular premium plans, policies 10 years or less can be surrendered after 2 years. A policy of more than 10 years can be surrendered after 3 years. Although the surrendering your policy is not advisable, documents you will need if you still wish to do so. That is original policy bond documents, request for surrender value payment, surrender form, NEFT form, bank account detail, original ID proof like an Aadhaar card or PAN card or driving license, a cancelled check or a written request. So the surrender value of a life insurance policy refers to the amount of money a policy holder will receive if they decide to terminate or surrender their policy before its maturity date. This value is calculated based on various factors such as the total premium paid, the policy's duration, any business bonuses accrued, and deductions for surrender charges if applicable. So it represents the cash value that the policyholder can receive upon surrendering the policy before its original term ends. So for a regular policy, the surrender value of life insurance policy can be calculated only after the policyholder has paid the premiums continuously for 3 years. Therefore, if you decide to surrender your policy on the first 2 years, you will receive no incentives from life insurance company. So the surrender value of the policy can be calculated as basic sum insured, that is number of premiums paid upon total number of premiums payable plus total bonus received multiplied by X, where X is the surrender value factor. So surrender value is determined by life insurance policy surrender processing time. There are two types of surrenders available. Guaranteed surrender value means under the guaranteed surrender value, the policyholder can surrender their policy only after the completion of 3 years. This means the premium must be paid for a minimum period of 3 years. If you surrender after 3 years, the surrender value will be around 30% of the premiums paid. However, this excludes the premium paid in the first year and premiums paid towards accidental benefits riders. So the later the policy is surrendered, the higher the LIC surrender value will be, life insurance policy surrender value will be. A special surrender value means it is usually higher than the guaranteed surrender value. This is how special surrender value for a life insurance policy works. If you pay premiums for more than 3 years but less than 4, you get up to 80% of the maturity sum assured. If you pay premiums for more than 4 years but less than 5, you get up 90% of maturity sum assured. And if you pay premiums for more than 5 years, you get up to 100% of maturity sum assured. So the maturity sum assured will be calculated based on how much premiums have been paid. It will be calculated as original sum assured into number of premiums paid, number of premium payable, plus total bonus received into surrender value factor. So private life insurers have performed well, and new surrender value regulations will trigger changes in the way the industry functions. So given higher payouts, insurers are likely to focus on persistency, and they must cope with the likely adverse impact on VNB margins. VNB is value of new business. So apart from focusing on customer acquisition with high persistency levels, they will have to review the higher upfront commission structure to encourage persistency by increasing trail commission. They'll also have to review non-par product, IRRs, that is internal rate of return, and consider new offers like loan on insurance to address customers' cash flow needs. So insurers have focused on ULIP as a category to drive growth since capital markets have done well, and higher ticket traditional products are being hit by changes in taxation. The new products and funds in the ULIP space will capitalize on strong stock market trends. However, the strong performance and the fact that these changes will ultimately make insurance more attractive to customers should drive growth in the medium term. Now, life insurance companies are planning to seek a 3-month deadline extension from the regulator on the implementation of surrender value norms. New product launches could slow down due to new norms which need to be implemented before September 30, 2024. Although insurers will need more time since revising all the traditional products and renegotiating commercials with the distributors on the revised products is a logistic challenge. In June 2024, the Insurance Regulatory and Development Authority of India issued the Master Circular on Life Insurance Products, wherein it introduced norms to ensure better payouts to customers who exit policies prematurely. So according to the revised norms, life insurers have to pay an enhanced special surrender value after the completion of the first policy year, provided the customers has paid one full year premium. Currently, companies do not pay such an amount to customers surrendering their policies in the first year. So the IRDA has changed these surrender value norms, and now new norms will come into force. Because these new surrender value norms are in favor of the policyholders. Now life insurance policyholders will receive better surrender value after a 1-year period and find their policies to be more liquid investments following an overhaul of norms by regulator, Insurance Regulatory and Development Authority of India. So IRDA issued a new master circular on life insurance products to address the pain points of these who have purchased life insurance policies. So the new norms require insurers to ensure that the special surrender value is at least equal to the paid up sum assured, paid up future benefits, and accrued and vested benefits. So the free look period, which provides time to review the policy terms and conditions, is now increased to 30 days from 15 days earlier. In the past, policyholders suffered huge losses if a policy was discontinued after a year. Now, however, the higher surrender value norms make it unprofitable and insurance companies to have customers who seek to discontinue their policy after a year and hence incentivize them to increase their business persistency. So, to ensure policyholders have access to liquidity in emergencies, all non-linked saving products offering surrender value shall have the facility of a policy loan based on the eligible surrender value. They would also provide for partial withdrawal from pension plans for emergency reasons such as higher education, marriage, purchase, construction of a house, or treatment of illness. So IRDAI said that the new rules establish mechanism to improve persistency, curb mis-selling, avoid financial loss to policyholders, and enhance long-term benefits for them. To facilitate financial planning and enhance the flexibility in premium payments, insurers are now permitted to offer products with a range of premium payment terms. So the overall of life insurance product norms comes in the wake of a regulator making health and general insurance norms more customer friendly. Just like in health and non-life covers, IRDAI has directed companies to improve their grievance redressal mechanism. So in case the insurer does not appeal against the award of insurance ombudsman and does not implement the same within 30 days, a penalty of Rs 5,000 per day shall be payable to the complainant. This has been provided now. So now the policyholders will get a better return on surrendering the policy because the surrendering norms have been changed and now surrendering has become rather more comfortable, easy and convenient to the policyholders. Not only that, they are going to get the high return also. So one of the main criteria for an insurance policy is that it needs to be long lasting. However, sometimes policyholders give up the policy before the end of the policy term for various reasons. It could be encashed to meet an urgent financial need or surrendered as an outdated policy that doesn't meet their current financial needs. So the surrender value of a term insurance policy, its types, now it's calculated, how it is calculated, and which policy can be surrendered before the reach. These practices have been changed now. Because surrender value in term insurance refers to the amount of money an insurance company pays to the policyholder if they decide to terminate their policy before its maturity. It applies only to those term insurance policies with a surrender benefit. So when a policyholder opts for surrender, the insurance company calculates the surrender value based on the number of premiums paid, the duration of the policy, and the other factors. So the surrender value is usually a percentage of the total premiums paid minus any applicable charges or fees. It is important to note that surrendering a term insurance policy means that the policyholder forfeits the death benefit, which is the policy's main purpose. Therefore, surrendering a term insurance policy should only be done after carefully considering one's financial situation and insurance needs. So the IRDAI rules say that anyone with a term plan can give up their insurance policy. However, only after the policy has been in effect for 3 years will the policyholders get the payout of the surrender value. The regulator decides that the policy surrender value is for the first 7 years. From the 3rd year on, the surrender value is up to 30% of the paid premium between the 4th and 7th years. So the surrender value could fall to up to 50% of paid premium. So after 7 years, the insurance company decides how much the premium should be. The general rule is that the closer you are to your date of maturity when you surrender, the more money and benefits you get. So surrender value calculation in terms of insurance policies varies from one insurance company to another. Generally, the surrender value is calculated based on the factors like policy term, premium paid, and policyholder's age. So in most cases, the surrender value is a percentage of the total premium paid by the policyholder. The percentage varies depending on the policy term and the number of premiums paid. It is important to note that the surrender value is usually lower than the total premiums paid by the policyholder. So this is the guaranteed surrender value is the minimum amount an insurance company pays the policyholder upon surrendering the policy. So the GSV, or the guaranteed surrender value, is predetermined at the time of policy purchase and is usually a percentage of the total premiums paid. While the SSV, that is a special surrender value, amount is offered at the discretion of the insurance company over and above the GSV. So the SSV takes into account various factors such as the policy duration, the number of premiums paid, the current market conditions, and the other such factors. The SSV is usually higher than the GSV, but there is no guarantee that it will be paid. When you think about all the different ways you can use the cash value in your life insurance, you might wonder then it is best to turn in your policy for cash. So even though life insurance premiums usually increase with the age of the policyholders, there could be a chance that one might be able to get a policy with a better sum insured or a bonus. So surrendering one policy to get another better one in its place is one of the common reasons for people to surrender the value. Sometimes emergencies require extra monthly expenditures, making insurance premiums unaffordable. The only option left is to surrender your term insurance policy and opt for a cheaper one in place. Thank you very much.